Hey everyone, and welcome to An Operator's Blog. In this episode, we will be doing a deep dive into some best practices for US go-to-market, especially for India-based startups. And joining me for this discussion today is Vinod Muthukrishnan. Vinod is the Chief Customer Officer at Uniphore, one of the leading enterprise AI companies in the US. Incidentally, Uniphore is one of the big success stories to come out of India. The company started in India and is now a market leader in the US. So I'm sure there's a lot to learn from there. Prior to this, Vinod was, of course, the founder of CloudCherry, which he sold to Cisco, and then went on to become the COO of Cisco's contact center business. Vinod has been a big evangelist in the US-India corridor venture ecosystem in particular. He's a venture advisor to March Capital and is also on the governing council of SaaSBoomi, which is probably the world's largest SaaS founder community today. So super excited to have you, Vinod, today.
Awesome. And for full disclosure, I have my SaaSBoomi / CloudCherry founder hat on as we get to this conversation.
That's great. And I think there is a lot to unpack from those experiences. So I want to do something interesting, Vinod, today. So I want to actually play out a few scenarios of what I see as challenges that US-India founders grapple with. I mean, I'm a venture investor in the US-India corridor, so I, of course, get a lot of founder interactions. And I really want to kind of then delve into your learnings as a founder and operator and see what are the practices, what are the recommendations that you would have for founders who are sort of going through those situations. So does that sound good?
Let's do it.
Okay, cool. So let's get right down to it. So the first scenario. So let's call this founder Pawan. So Pawan has just started up in India. He has an MVP in the market. It seems to be resonating with some early design customers in India, but he knows that the real market for his startup is in the US, right? So of course, he doesn't have enough understanding of the market. He does have a B1, B2 visa. So he decides to come to the US, spend a few months here, understand the market, literally lands up here. Now, Pawan has kind of never worked here, probably not also sort of studied here, does not have any networks here, but really wants to understand and stress test his assumptions, right, around building his startup and his product. So how would you advise that he approach it?
Awesome. So my first advice to Pawan is, a lot of advice like the one I'm going to give is free. I always say the greatest founder superpower is what advice you don't take, right? Yeah. Ultimately, investors, advisors, what have you, will help offer options. Most of them are not on the hook for the success or failure of those options. So please take whatever advice I give with a pinch of salt, right? You got to apply it to your context. So simplest example is, you talk about go-to-market. Oftentimes we talk about US go-to-market without the context of what domain, what end of the market you're selling to. For example, if you started with SMB Freshworks, your go-to-market methods and techniques would be very different, right? As opposed to if you started like a Uniphore enterprise. So first, that context is important. So I'm assuming if Pawan has design partners in India, it's an enterprise business, right? Higher end of mid-market and enterprise, which means you do and have an enterprise sales motion, right? Now, interestingly enough, this is how I was in December 2016, moved to the US, had no networks, hadn't studied here, had sold into the US, but that was on the East Coast in the trading space, which was nothing to do with what I was doing with CloudCherry. And here's the foundational thing you got to consume. Everything around enterprise, I'm talking enterprise now, right? Everything about predictability, go-to-market, that is something you discover. In fact, enterprise startups can become predictable north of a 50 million of ARR, right? It's possible, right? So what Pawan is seeking is not predictability or method. Pawan is seeking anyone who's his archetype, right? Anyone who's his ICP. So it really goes back to the first foundational question, which everyone talks about but doesn't spend enough time on, which is who is truly your ICP, right? And people very loosely assign ICP, saying, oh, CMO or whatever. But let's say you had something which accelerates performance marketing. The reality is that's not a CMO priority. CMO may be of a late stage startup, may be thinking about IPO branding, analyst relations, right? On her plate, there may be things that are higher up the order than something that enhances performance marketing. So your ICP actually is you can say CMO, but then she's not interested. You may have to go to whoever's running performance marketing, right? So ICP definition, role, rank, title, what do they look like? What do they do? What else do they use? What is the pain that you're solving? Why would they lean in and pay attention? A very, very foundational and honest understanding of that is important. I always find that softwares that don't have a very, very precise buyer often struggle. Now, why am I telling you this before GTM? Because we're not talking about science and method. We're talking about any five early adopters who might come in front of you, right? So literally doesn't matter if you found them, I don't know, on the street. It's okay. So the point is, how do you get in front of them? If I were doing that, and which is something I did, I think 7.5 years ago, I would leverage every resource I have. So first, you look at your network. If you have investors, if you have friends, advisors, a lot. If you're an early stage startup, you should definitely leverage the power of the founder angel investing community, which is you get a few angels on board. They can usually be very helpful. It could be the diaspora here, but very importantly, never forget the power of a mission-driven founder reaching out to his ICP, even on LinkedIn. The reality is, if you're truly solving pain, right? And that's why I said honest assessment of ICP, the problem being solved. Imagine I reach out to you and I tell you, I'm just taking a very wild guess. Hey, I've got this fabulous hair regrowth formula. Now I'm seeing you and you have fabulous head of hair. So if I'm not honest about do you need my product or not, the fact is you may be my ICP, age and this and that, but that pitch is going to fall on deaf ears, right? So you need to have a very, very real understanding of if I were to reach out to this person and make the case for X. If I reached out to you, for example, and I said, I know this fabulous operator. I know you run this blog. This person is incredible for go-to-market. He's helped 20 startups hit their first million of ARR, right? He truly knows how to do this. You will lean in and pay attention, even if you didn't know me, right? And that really is the essence of it. If you're reaching out to some and you really want him to lean in and pay attention, have you identified the right person? Do you have the right pitch? You'd be amazed. You could literally cold outreach people because you need to succeed with 5 or 2 or even 1, right? Not 500. You're not trying to figure out go to market. You're trying to get a transference of your design partner set. The reason I say that is your requirements of your design partners between US and India may be dramatically different. I actually feel in enterprise businesses, barring some very few segments, your product market fit is per market, right? You come in India, you have 1, 2, 3 million of ARR, your customers require a different set of things. You come off to the US, if you're a vertical specific product, the verticals are regulated different in different industries. If you're doing it for banking, for example, right? Let's say you're doing compliance stuff in India, compliance rules in the US may be entirely different. So your product may not actually out of the box fit the needs of a US customer, right? Everything about the market in an enterprise business could be different. For example, you go to Europe with data and privacy, your teams in India no go, like you can't do business here. Now at an early stage, can you put 5 people in Germany? Maybe you can't, right? So this is a very important rubric. If you really know your ICP, leverage every asset you have, right? You have to go out and evangelize what you are, who you are, what your brand is, what you're trying to build. And essentially, the most important thing for a founder to consume very early in a startup's life, you're not selling product, you're actually selling conviction. I'm telling you, I'm pitching to you, son, and I'm telling you that I committed my entire life. I left this job in Google or Facebook or where have you, right? And changed everything about my life to take a plunge to do this one thing. And I know this is important to you. Do you believe in my conviction? Does the pain resonate with you? Does the fact that someone's committed their entire life to the resolution of that pain, does that appeal to you? Let's have a conversation. So what did you sell here? Not product. You sold conviction, right? And when you have the conviction, you can cold prospect anybody you want. So lean on all the resources I told you. Notice I didn't tell you anything scientific. I essentially spoke about hustle, but do not forget the power of what your conviction can do, which means reach out to anybody that you think is your ICP. And don't be surprised if you reach out to a few hundred people, you might actually get 5 people who care about the problem enough and are often in the bell curve of an early adopter kind of DNA who might actually reach out and give you a shot.
So much of this resonates with me personally as well, Vinod. In fact, I want to sort of highlight 2 points. So one thing I learned in my own founder journey, and which now almost as an investor now continues to get underlined every day, is that even asking for help is an
Mm,
art, right? It's something that kind of people have to work on, right? And especially I think coming from a different geography, and I think Silicon Valley, I mean, both of us are here, and we have kind of seen how this network operates, and the it's almost very hard for people who are not here in this ecosystem to understand how much paid forward really happens here, right? So I think that is one kind of thing that really resonated. Second was, I think, the mission drivenness and the storytelling part of it. In fact, the first pod that I ever recorded was, doing a 0 to 1 in cybersecurity, where founder Bucci, who's the founder of Levo, so he came in and he said something very interesting. So he sells cybersecurity software, very large,
mm.
250K, 500K CV deals. And he's like, 2 years in, I realized that even these enterprises and these CIOs and these secure heads of security are also buying my story. And so almost 3 years in, he then said, I had to then get on LinkedIn and I had to kind of also say, why are we doing this, right? Instead, of course, the product is important and the job to be done and the unique value proposition, all that is all there. But ultimately,
Mm.
what resonates, even with large enterprises, which is kind of quite counterintuitive to what many people would like to believe, the story and the mission drivenness and what you call, I think, conviction really resonates.
I'm really glad you say that. I'm sorry, I know you highlighted 2 points. Let me highlight 2 points back.
Yeah.
Asking for help. The differences between, hey, Vinod, there's some, I'm so and so founder of ABC. We are in the XYZ space. I would love to chat with you. Who cares about that outreach? Honest answer, right? But if I reach out and say, hey, so I know you made the journey from India to the US, you've been a founder, you've been an investor, and I know you really care about this. I've committed my entire life to building around this. And I know that you'll find value in what I'm saying. I just love 15 minutes of your time just to tell you why I chose to give up a life of comfort and what I'm just making this up, right? To solve for X. Even if you're halfway in the ICP matrix, you'll be like, listen, this guy seems legit, right? Let's talk to him. That is what you're selling conviction. So you're absolutely right. How you ask for help. Sometimes, I'll be honest, like I got a message from somebody recently saying, hey, XYZ, I believe you have good connects in the investor community. Can you make some connections? I kid you not, that was literally the message. And I'm like, guys, come on. Like, I didn't know who you are, what you do. And it's just so
Yep.
unfiltered, right? I appreciate the honesty, but you're not going to get, if I message you and I said, someone reached out to me, they wanted to connect with you, here's your connection. You won't lean in, right? You'll say, okay, you'll say either I'm busy or you take a meeting because you took a meeting. It doesn't help you with anything. So I'm glad you said that. It's the fine things that work, fine things that matter. We get too caught up in the science of it, which you need to scale. But the art of it is what I think most founders grossly underappreciate.
Great. So moving on to the next scenario. So this is, again, I'm making this name up. So it's a founder. His name is Karan.
Mhm.
And so Karan is, he's now couple of years into building a startup in India, has actually gained fair amount of traction. So maybe his startup is doing 100K to a million ARR. There is he's raised a seed round, kind of is has sort of good validation. But of course, the holy grail is the US, and even his early investors are like, look, go after the US market and go and take the product there. So he kind of lands here and starts having conversations and realizes that, hey, this is a totally different market. I mean, something that you mentioned earlier as well. And so more importantly, the product has just gone down a different track, right? So he has used up a lot of the runway. How does sort of Karan go about a kind of managing the situation, managing expectations of all stakeholders as well, right? And really make progress.
No, this is such a pertinent question. I think a lot of us started off in the US because that's all we had access to. In India, sorry, right? That's all we had access to. Um, Again, I spoke about PMF per market, right? You have to understand, let's assume you have I'm giving you the best case scenario, which is product market fit in India. That's not the same as revenue in India, right? 2 million ARR in India means you could have 100 customers, right? 50 customers, and yet no PMF. So, we should not confuse the two. Revenue is a great proxy for PMF. It's not a substitute for it, right? And why am I telling you this? The reason I'm telling you this is, let me give you the most flattering end of that scenario, which is you have product market fit. You have customers, Raving customers, you have product market fit, happy, right? If not, you'll see as I describe what happens next, it's much worse than that. What happens when you have a lot of good customers? Your best minds, you, your co-founder, your engineering lead, your product lead, your best customer success folks, your best product specialists, right? Solution engineers. Where are they focused? Where are they based? They're based in India, working IST, right? Focused on Indian customers, right? Working on the India time zone. You've got your entire org to wrap itself around the customer set that you're solving, right? What happens when you move to the US? You move to the US, right? Then you ask your core team, listen, guys, let's start doing some calls in the evening, my evening, your morning, your evening, my morning, right? And then so you got these 2 or 3 hours a day where you're overlapping, right? 2, 4 hours a day, you're overlapping. But the reality is you don't have an org structure built to support your US customers, right? A global clientele. So now you get your first customer. Then you say, okay, you know what? I'm going to get all of these people and I'm going to get them to work US times. And now you're bending your company out of shape. You already created a structure for success, 2 million of ARR, right? And you're not trying to change. The reason I start with this as opposed to many of the other things is you got to realize when you get PMF in a market or you get scale in a market, your team, company, employees, orientation, time, how you where you put your chips, all of that align towards that, which means the lack of runway is the least of your problems, or rather it is. But even if you have runway, you have to almost metamorphose as a company into something else to do US go to market, right? But now let's get beyond that. Okay, let's assume everyone miraculously starts working in the night, and the fact that your India customers will now no longer get the platinum service they used to get. Let's assume those are surmountable problems. Okay, and you've done it. What is the other problem you face? You realize that everything about your go-to-market, your messaging, your this, your that, is actually tuned to that market. Your sales method and process is tuned around that market. Your language, your case studies, transference is very low. You may have a fabulous enterprise in a different geography. And I'm just forget India or the US. India is probably the fastest growing large economy on the planet. So we shouldn't undermine where that's at. But let's say you have a customer in Thailand who's the number one something in Thailand. There is no brand recollection or connection to that in the US, which means your referenceability is low. All the things you get to drive conviction as a 2 million ARR company, many of the weapons in your toolkit cannot be used here, right? Which means you need to now act like a zero revenue company in some senses, right? You can say we have this much revenue in Asia, there's credit for that. So imagine being a 2 million ARR company with 100 employees needing to act like a zero ARR company that should ideally have 20 employees, right? Now, no more. That transition often doesn't happen. So you try to take what worked in India and try to make it work here, and it often never works. You can ask companies that have gone to 2, 5, 10 million ARR in India and then, or Asia or Middle East, Southeast Asia, you'll realize that it's very hard to make the transition to the US because you often start with half measures. Founder moves, or you even worse, like founder moving is great. You hire a VP of sales from, it's a remote hire, and then and we'll talk about that a little later. But the point is now you're outsourcing your destiny in the most important enterprise market on the planet to a third party, right? And then you take a little bit of your marketing muscle and say, I'm going to enable this person with X, or say, I'm going to allocate $500,000 to this market. In the scenario you mentioned, runway is running out, which means, oh my God, I'm going to move, but the founder has 6 months runway to make it work or come back, right? These are all pressures you put on yourself that are counterproductive to the building of a great business, right? Simple fact, I'll say something that many founders will disagree on, which is you're getting a customer willing to sign, but you realize that that's not what you really do. Would you take it? Or would you say, no, I'm trying to transform my PMFs. I solve for X problem. I'll actually stay true to that course and not take on this customer, right? Will you take that call when revenue is in the line? Maybe not, right? Now, we know founders who at 4, 5 million ARR discovered that what they really are solving for is X, which means they're willing to give up on the trail of revenue and move to that new business. But that's a big change. I'm talking about something more subtle, which is you're building for X, someone comes with a slightly adjacent requirement, right? It's coming in the way of predictability, but this customer needs it, but they're going to give you 200K, 250K, right? First deal in a big market. You've told your board, you've been here for 5 months, you want to show some success. The reality is 9 out of 10 of us, maybe I myself would take it. But what have you just done? You just committed yourself to a services offshoot to your product business, right? And even if you slam dunk that use case, you're not sure if that's replicable. You're not sure if there's a large enough market for it. You're not sure if it's a custom requirement or larger need of the market, right? You've just cannibalized your own business, right? Or rather, put it on a little fork because you wanted revenue. So that's the kind of pressure that I really worry about that founders face. I'm a huge believer in go slow before you go fast. I know enough founders who've taken money but are going slow, really searching for product market fit before they, pedal to the metal, so to speak. Um, and that's a concept I genuinely believe in. So when you're trying to change the way your company is oriented, transfer your product market fit, go from being a 2 million 100 employee company to a zero revenue, 20 employee company. When you've got a product market fit and a belief in what works and you try to take it to a new market, so much changes that this is a scenario I would ideally, if I were involved in the company in seed stage, I would ask them to avoid. The best solution for this is to prevent this from happening, right? Um, I generally feel that at 2 million ARR, you don't have the muscle to be a multi-geography enterprise sales company. I just feel I may be wrong, and maybe founders may put their hand up and say, I could do it. I would say you're not. You have to focus on a primary market. If all things being constant, if being a horizontal product, not having some other issues, if US is the market you want to go after, I'd say you should start in the US, spend the hard miles figuring out what the problems of this market are. So my solve for this is to turn back time and prevent this from happening, because it's a real hard problem to get your way out of.
Yeah, I think this is exactly what Rajan Opeka, who's sort of a common friend of ours, said recently on the last pod, right? Which is, if you are going to go after US market, you start here, right? You don't, and you do your best to do that. And I think, what you just said about focus and about, really zoning in on who the customer is and what market is. It reminds me of, I think I read it somewhere. I don't know if Paul Graham or someone said it, that the real litmus test for focus is what attractive opportunities you are choosing to not pursue,
Fantastic.
right? I think that, to me, like, it really resonated with me. And in fact, in my own startup, one of the things I learned was the whole concept of firing customers, which is, you kind of, yeah, in the early days, especially first time founders, you're always very, very desperate, right? Like, you're just looking for validation and you're looking to kind of build out your assumptions. But then do you carry on with those customers, those early customers? That's a very tricky emotional business commercial situation.
One of my early mentors, Dr. Balachandran at Kellogg, Great Lakes, he said, uh, not that I went to either institution, but he said there's customers and customers, in Hindi or Tamil, you'll recognize
Yeah.
what custom means. And it's really important. You're right. That's why I gave the example of the 20% fork in the road, right? Which
Yeah.
is, it's an adjacent use case. We can take it, right? Before you know it, you're a quasi services company at 2 million ARR, right? It's just, you have to understand, good news grows linear and the bad stuff like goes exponentially, all the mistakes you make early exponentially grow in time. The
Yeah.
debt you accumulate is
Yeah.
significant, right? And that is why and it's very, very easy. I'll tell you one thing. If we were sitting in a room with the founders and, man, I'm getting, this is the problem, I'm getting this $500,000 deal, I'm a 2 million ARR, but it takes for these compromises. The reality is, when push comes to shove, we'll be like, look, this is how life is, right? You got to do this.
Yep.
Yet, the difference between the truly great founders and the ones who also ran is that at that fork in the road, they chose to do the right thing for the longevity of the company, right? The difference between average investors and great investors is, look, I believe in your conviction. I invested in you because you were solving for X, right? This looks like X.5, right? I'm not sure what the market for X.5 is. I'm with you, like, build for the right thing, right? And this is, I mean, if this were easy, I mean, you've seen so many founders come to you, been a founder, I've been a founder. I mean, it is so hard that I'm not sure if I want to start a startup again. Okay, so it is genuinely, truly, legitimately hard. Don't make it harder,
Yeah. Yeah.
right?
Yeah.
That's what it, and easy choices, uh, and acceptable compromise, which seems like an okay choice to make,
Yeah.
is the path to mediocrity. And remember, you will raise your early money. I'm assuming a lot of people will raise venture at valuations. Your valuation is, and so correct me if I'm wrong, like, it's more a bet on your future potential than your actual current day value, correct? Which means you got to grow into your valuation. And the pressure to grow will always be there. And the moment you go from one is zero revenue, which is infinite potential, and then early revenue and high growth, the moment you go to some mid-size, which is not IPOable, not whatever, and you're flattened your growth, your value will go back to where you were when you were zero revenue and infinite potential, right? If you understand that game, you'll understand that you should not be optimizing for short-term gain. You really should optimize for what is truly well, which belongs to like it goes in the bucket of what customers you take and not, what money you raise or not, how you capitalize your company, who you hire, what you invest in. All of that goes into the bucket of things you need to consider as you look at what you're building for in the long term.
Yeah, absolutely. And I think very rightly said where you said that, look, this is a scenario that actually ideally should be avoided, right? So this is something to not do or kind of be wary of the situation. I have seen this a lot in the 2020, 2021 vintage of US India cross-border startups in particular. And where it gets tricky is that because capital was so freely available, that you now have kind of VCs and even sometimes kind of large VC funds who wrote, kind of smaller option value kind of checks. So these are very hard conversations to have with kind of VC investors, right? Because you kind of come to the US and you're like, oh my God, this is, as you said, this is a zero revenue company. So, but I have now this VC who's sitting on my cap table who wants a markup, and for the right reasons. I mean, that's the business that investors are in, right? As a founder, I mean, how do you have those hard conversations, especially as a first-time founder who does not necessarily have the experience of managing investors or managing these these interpersonal relationships with the partners at these funds, somebody who's on the board, right? Like any experiences from your from your career there?
As I always say, the way out of a sticky situation is to go back and figure out what you can do to prevent from getting there. So let's take a little segue in the conversation, right? And we'll come to the answer.
Yeah.
If you look at sales teams, everyone's got a sales team, right? If you have a large sales team, this may be not doesn't apply at 3 sales reps or 5, let's say 50 sales reps, 100 sales reps, okay? And then you add an incentive. You say, hey, you know what? If you sign a deal this quarter, I don't care about 1-year term or 2-year term or 3-year term, right? I'm willing to offer you a 20% discount, right? Because this quarter we need to make our number, right? For whatever reason, there's a 5% spiff, okay? Miraculously, a lot of deals will close. All of them will be 1-year term. All of them will have the maximum of the 20% discount, right? In large groups, you got to understand the incentives drive behavior, okay? Why am I telling you this? You've got to understand who you're dealing with. Are you dealing with a sales rep? Are you dealing with a founder? Are you dealing with an investor? When you go the venture route, right? There's many ways of building a business, right? We know incredible bootstrap founders, right? Zoho is not exactly a venture funded startup. At the same time, I got acquired by Cisco. Most people see the scale of Cisco. You don't realize that Cisco actually was a venture-backed company, right? Sometime back in the day. So venture has created great companies, but you've got to understand the venture model before you take venture capital or commit yourself to a life of building using venture capital. Venture has to return money at a fund level, right? And I'm assuming all well-meaning people here, well-meaning founder, well-meaning investor, everybody, right? So if I'm managing $500 million and I need to return money at a portfolio level, I have a hurdle rate of 1.5x, right? I start making carry when I return more than 750 million. You've got to understand, if I put 5 million in you and you're not going anywhere, I'm not going to triple down on that bet. That's just the truth. Now, it's nothing wrong. That's why I said all well-meaning people, right? They have to show the portfolio is growing. So if you're dawdling along and you're not growing, doesn't look like you were the 100x bet that I thought it was when I put that 5 million, I'll just cut my losses and I'll move on to the next best thing, right? It's not personal, right? I may still be your best friend, right? We may sit down and I'll host you for dinner and I'll like, give you a shoulder to cry on. Why am I telling you this? We often say, oh, you're not founder friendly, investor didn't support. Investor's job is to deliver money at a portfolio level, right? From investors, there's a fiduciary responsibility to treat that money responsibly, correct? Which means you're not going to throw good money after bad. If you know this, then you'll understand why some of the pressures come to you, right? If you have to raise another round, you need to show at least not, mark your book up if it's not DPI, right? At least mark your book up and show a notional increase in value. These are pressures they face. If you don't understand it and you assume everyone will come there and just do what is right for the company, then you're not seeing the counterpart. It's like telling the same sales rep, hey, I know I offered you an incentive, right, to close a deal this quarter at these costs, but listen, hand to heart, what's good for the company? 3-year deals. Why aren't you closing multi-year deals? That doesn't make the sales rep bad. Sales rep is doing what you're incentivizing, right? So that's the very foundational understanding of the venture model that I think all founders should have. Once you know who you're talking to, right, you can have the right conversation with them. Oftentimes, founders go in and talk about things that don't matter, which is, I'm building right, I'm doing this, you need to support me. No. You need to show a way. If you're stuck in this jam, right, you've got to appeal to what each constituent needs and wants. If you understand the model, the point is, will this be a large company and a large outcome? Yes, no. No matter what happens, I'm not saying you have to answer exactly that question. When you're presenting a case for why you need more capital, why you need a bridge, we got a bridge from our investors when we moved to the US. We hadn't did the next round. I had to go back to the IC to pitch, right? But the point was, there's a massive market. We can take a significant share of that market, right? We've spent a little more money than we thought we would, but there is significant customer interest and traction, investor interest. I need a bridge. I need to just get to that other side. Do you believe in the long-term value creation opportunity of this business? Yes or no? If that macro answer is yes, many of the micros are okay. Instead, I'm solving for the micros, right? Which is, why don't you just give me more money? I need more money. You're not founder friendly. Like, their job is not to be founder friendly. Their job is to make money for the investors. In the course of that, it is to find the right investors and double down on them and be a true friend and philosopher and guide and what have you, right? And that is why I go back to understanding your counterparty, and then you'll appeal to the right motives for them, right? I find a lot of founders just expect that whatever incentive they had is the same incentive the other person has. You committed your entire life to this vehicle, right? For the other person, this is one of the 25 bets that they've made, out of which 3 or 4 need to work to return the fund, right? So you can't expect the same thing off of them. The counter of this is also true, which is, I know this is a question you didn't ask. Why should founders underpay themselves? Founders should not underpay themselves, right? I know it's an unasked question. So I'm telling you how you should not expect investors to behave orthogonal to what their incentive structure is. Likewise here, you've committed your entire life to this. 5 years later, if this doesn't work, you're stuck with zero, right? Now the logic is, oh, you own 30% of the company, so your upside is, that's great, but what about the downside, right? So this is also a case for saying, pay me market, right? Pay me what's fair for someone of my skill level and talent who's managing let's say, a $50 million asset, right? That's the valuation of my company. How much would you pay for someone to safeguard $50 million of value, right? A reasonable wage. So that's a two-way street. So I think everyone needs to understand what their role in the ecosystem is, what the incentive and motivation structure for the counterparty is. If you do, then you'll argue using the right logic. I'm not getting down to what the logic is, right? Because it depends from fund to fund. If there's a fund that's on its 7th or 8th year and they have intense pressure for liquidity, right? And they've not yet raised the next fund, or the next fundraise is going on and everyone's saying, where's your DPI? They will be motivated by different things. That's just the truth, right? So which means there's so many other elements of fact that determine what you should be telling the investors. But understand who they are and appeal to the right elements of what should motivate them and not what you think is right for them. That's what you care about. That's not what everyone else cares about.
No, this is great. I think I love this insight of almost having game awareness, right, as a founder. I think that's going to be super important. I'm loving this scenario format, so I think the experiment seems to be successful so far. I'm going to take a little bit of detour and then come back to 2 more scenarios, but I want to get into a little bit more brass tacks of go to market. And Vinod, I think you and I, when we were kind of prepping for the pod, right? I think now we have those case studies coming out of India, where kind of US-India cross-border startups are now seeing kind of early successes, right, in terms of various go-to-market approaches in the US. And I think you highlighted SuperOps, Rocketlane, and Spendflo, right, as 3 companies which are actually doing well and kind of making really good inroads into the US. But everyone has a very different approach, right? And I felt that this is going to be really contrasting these approaches would be really, really helpful. for cross-border founders out there, right? So could you spend like a couple of minutes on kind of each of these? And then you as an observer, what are you seeing in terms of what is working, right? Like why have they gone for these approaches, and what can people kind of derive as insights and learnings out of this?
Someone decent. So first disclaimer is three founders, three very good friends. I know them personally. None of this is driven by what I might know about the company. This is me looking outside in,
Yeah.
right? And that's just want to be very clear. That's the hat I've put on. Um, so let's look at these companies, right? Someone asked me recently, um, what do the great founders have in common? I think great founders have one thing in common. Early on in their life, they either know exactly what their go-to-market is or they figure it out very early, right? Um, Founders who go with the vague notion of, I'm better than Salesforce. So let's say you're doing sales CRM. So the VP of sales should pick me over Salesforce. That's a very, very vague understanding of who your buyer is, why they should buy you. The reason I'm saying this is, look at these three companies: SuperOps, with Arvind, Shri with Rocketlane, and then Rajiv with Spendflo, right? Look at these three companies, very, very different companies, very different spaces, okay? But as I thread together what they've done well early, you can kind of figure out what early stage founders and companies look like, which gives you some sight that this might be successful. Now, whether they're going to be at 100 million revenue, a billion, I don't know, right? So let's just talk about early success.
Yeah.
Zero revenue to PMF to 10 million ARR. And then, each stage, there's a different set of things you need to do to succeed. So let's start with maybe Arvind at SuperOps, right? There's a few superpowers that SuperOps had, right? The founder understands performance marketing like in his sleep, right? Has picked an unsexy space, MSP. Like most people don't know the full form of MSP, and the ones who do don't know the size of that market, right? So what has he done? He's taken an unsexy market, large incumbent, correct? Huge TAM, gone super deep, correct? Pick the lower end of that market and said, I'm going to do performance marketing, get in front of them, build a better product, like faster, better, cheaper. Clayton Christensen's typical disruption, right? It's a Freshworks model that Freshworks has done better. Gone back to what he knows really, really well. All these years of experience with Zoho and building his own startup and Freshworks, to go back to say, I know these things really well, right? Let me solve for that in this space. Fabulous sort of awareness of go-to-market. What's the route channel preference, performance marketing? Who are the channel partners, for example? Who the incumbent is? What's the competitive differentiation? Very, very clear, right? And I love it, right? There's a reason that company is growing fast, okay? Let's go to Rocketlane. Very early awareness of who they are solving for. I told you earlier in the pod, each software needs to have an owner. Someone who says, this is my software. Not this is also software I can use. Very different, correct? If you ask a VP of sales or customer success, if you ask a customer success leader, show me what you use, they're going to pick up whatever platform is, we know the customer success platform, right? They'll proudly demonstrate that software, right? I once remember we had, I think the CMO of, I think it was HDFC Bank in India, Karthik Jain. He went up on stage at a Microsoft event and they asked him about customer experience. I kid you not, C-suite person picks up the CloudCherry dashboard, runs a demo. This is how I use my stuff. And I was like, this has never happened before, right? Usually C-suite doesn't do product demos on his own. This is not because I asked him. I don't think I had the agency to ask him. But when someone asked him about customer experience, he wanted to show the data-driven approach to customer experience, he demoed the product, right? Why am I telling you this? He believed that this was his product. His priority was customer experience, and this is what helped him achieve it. So you go back to early creation of the community, right? The pre-flight community, pure understanding of the delivery PS teams are the ones that use it, right? Why not an Asana? Simple here. So you show this person a generic project management tool, right? Or a project, whatever, task management tool. And you show organization like, you know what? In theory, can this morph into this? Yes. In practice, no. I'm not here to run a science experiment, right? I'm here to deliver, I'm just saying 50 million of ARR or 20 million of ARR every year. I need to succeed in my job. I need all my teams to be following standard software, standard process, standard whatever. So ICP understanding is superlative. Community creation around that ICP is very good, correct? Sticking to solving all problems that buyer may, like I would like to think I've contributed to the product roadmap by saying, why don't you also build this? So which means you take an ICP, one buyer, and say, I'm going to solve all your problems, right? Everything that it takes for you to succeed is within my realm of responsibilities, which means there may be large vendors who also sell some product to this person. But if you create a specialist module for this person of that large vendor, you can pick 50 million of their TAM and append it to this buyer, right? That's why I'm very, very excited about where that company can go, right? Third, you see Spendflo. I think, to the best of my knowledge, they realized that it's a two-in-a-box buying decision, right? You've got finance and you've got functional leader, IT, whatever, whoever's responsible for consolidation of systems that you use. So I saw a LinkedIn post, again, that's why I said outside in, that they did 35 exec sit-down roundtables last year, right? That is one in 10 days, right? Approximately, if you see the year. I think that is spectacular. Once in 10 days, the founders are sitting in a roundtable. Look at this go-to-market. Nothing to do with performance marketing. It's not that they're not doing. I'm sure they're doing other channels too. But what am I seeing from the outside? We may do performance marketing, we may know our ICP well, but there's a nuance there. I need to bring these sort of different people in the same room, right? CFO has a different incentive structure. Maybe the head of IT has a different incentive structure. I need to bring these people together in an environment where my evangelists are there, talk to them about what's important. They're not going to see a banner ad for reduce your, optimize your spend, or maybe they do, I don't know. But I'm seeing one go-to-market approach which is radically different from the other two that seems to be working really, really well, right? And I will add one thing to it. That's probably one of the most persistent founders I've ever met. I know him personally, and 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 forget all the science of what you do. That he needed something from me. I won't get into the context of it for his business, okay? And have never had someone more doggedly and persistently follow up with me using every trick in the book in a non-recorded environment. I will tell it all legit tricks, of course. But I love that. Like, great founders are just persistent. Like, they don't give up, right? So you see three different companies, three different segments, but all of them had something foundational. One understood you needed to get constituents together and get them to talk. One understood exact buyer and then said, I'm going to solve for everything for that buyer and increase my time along the way, right? Create a community around it. One understood a segment that is underserved with a large incumbent that is ready to be disrupted. Use the performance marketing and channel partner route to really go deep in and just be a typical disruptor in a space. And very, very radically different go-to-market models, but all of them worthy of emulation. The founder superpower is what is relevant to you. If you're going to the high end of enterprise and need CIOs of Fortune 100 banks and you're optimizing on your performance marketing, you're probably spending your time in the wrong place, right? That's my takeaway from these very different use cases.
And almost these three case studies are sort of taking me back to what you said right at the beginning of the pod, which is the importance of the ICP, figuring out the customer. I think that seems to be almost the common thread across these three companies, that razor sharp identification of the ICP, understanding what problem you're solving, and then automatically I think the things start lining up, because then you know how to reach out to them, to what language, and to sort of communicate them with, or how to position themselves. At least, in fact, I mean, just to give us, I have recorded a podcast with Nivas, who's the head of marketing at Spendflo, because personally, I found the whole kind of using curated events to drive go to market. I've not seen any startup do it this way. They are fabulous,
Right, exactly. But the founder is, I'm sure that when they started out,
Yeah,
they didn't think curated events is going to be the way out,
yeah,
right?
yeah,
They tried a few experiments,
yeah,
understood what the ROI of one was, right? The
yeah,
founder always needs to have a learner's mindset,
yeah.
right? And then, I mean, double down is an understatement. 35 curated roundtables in a year is not called doubling down. There's a number that's bigger than doubling down, right? And I love it. I think that's what great founders do.
And it's a lot of work. I mean, the kind of nuances that came out in that discussion. So this is not low hanging fruit GTM. This is really grinding it out, but because you know who your customer is. So you then kind of start iterating on one channel, and then it starts working well.
Exactly. Look. My dog. Obviously, you can see is uh, at the back, and she's motivated by three things only. One is treats, food. Next is belly rubs, and third is a walk. Right. If I throw any other incentive towards her, I mean, if I offered to read her poetry, I'm sure she'd be like, "Yeah, good for you, dude." Like, move on. You've got to understand that at a primal level, all human beings are driven by a certain set of incentives, either personal or professional, right? You've got to, the heart of good go-to-market is to appeal to what moves you, not why I believe you should be moved, right? Um, Conviction shouldn't be the wrong thing. That's really at the heart of all GTM. Then you got to find a method around it. It could be performance marketing, it could be curated roundtables, it could be succeed in your role as the delivery person, whatever it is. But that's what you need to do. That's what great companies are built on.
No, I think these nuances are there's very less information about these details, right? So I think all the founders out there who are going to listen to the pod are going to find this very helpful. Coming back to the final two scenarios, I think the scenario format that I started out with. So scenario number three. So the founder, it's let's call her Neha.
Mm.
So Neha is been doing founder-led sales now for 2 years. Came to the US, done well, has PMF, has now even raised like institutional round here, right? But it's been a very founder-led kind of sales model. And now she's like, look, I have capital now. I need help. I need to kind of bring in, the right sales talent here, maybe a VP of sales, head of sales, whatever you call it from a title perspective. But still the founder is only 2, 3 years in this geo, right? Like the networks are still limited. There is capital now and there is a VC on the cap table, but
Mm.
but those relationships are still kind of very, very new, right? So what are some of the things that Neha can do, right, to effectively run a process in terms of identifying people who can sort of join the journey at still a fairly early stages of a startup?
So Neha is already here for a couple of years and they have some scale, right? They've got
Yeah,
customers and
correct,
whatever.
correct. And they've also raised a round.
They've
Correct.
raised money. That's definitely helpful, right? So
Yeah.
you've got money, you've got an investor on the cap table, which means growth rates are important. You raise that money. Again, it goes back to understanding your constituent. See, when you do your investor pitch decks, again, I'll take a segue before I come here. You talk about tripling, quadrupling, 5xing, 10xing. Remember, even casually, if you're talking to an investor and saying, "Yeah, I intend to triple this year," not that they've made a note, right? You meet them after 1 year and then you've grown 20%, right? You've not lost momentum, you've lost credibility. Okay, so founders have to understand that you may not be a public company CEO wherein your sensitivity has to be 2% or whatever, but your credibility is always in question, correct? There's always a need to establish credibility. So you've raised money promising a certain rate of growth, correct? First thing first, going back to the board, you've got a level set on, and I think all investors will put their hand up and say, I know you said you'll triple this year, but listen, if you don't just burn money doing stupid stuff and you grow reasonably and show me that you have the basis to grow faster in the future, most investors will say, don't worry about it, right? Do it right, do it sustainably, build for the long term, right? And if someone doesn't, then you made a mistake already. But let's come back to she's there, right? She understands where the market is. I'm hoping with this traction, Neha knows one thing that no hired VP of sales can give you. Neha has absolute conviction on her ICP, what resonates with them, why they buy, right? Who she competes with. Because the reason I say, and what does it take to close, right? One is why do you like what I say? What does it take for you to buy, close? Very different incentives, right? Um, so the reason I say that is oftentimes founders make a big mistake. This especially happens if Neha were 2 years earlier after of Neha. Neha will come in and find this um, sales leader who will come in, will have a very aggressive sales name. You'll hear the name and like, wow, like this guy. It's usually a guy. He looks like he's got the Rolodex, he's got everything sorted. He's just going to come in and take this baby off. The problem is then you're outsourcing the job of PMF to someone who doesn't understand customer context, pain, solve, close as well as you do, right? In Neha's case, she does, right? Why am I going so deep into this before I get to the team? What are you hiring for is the question I'm asking. Are you hiring for, hey, I know exactly how this works, but at n equal to 1 unit, I need someone to come in and scale the process. What I'm not good at is hiring SDRs and account execs and, I want someone to build the machine and the system, okay? You could be hiring for that. Second would be to add velocity and momentum, which is I'm the only one. I just need more people. Because if you're still very early, the founder understands sales, right? I always say there is nothing called a non-sales founder. You could be an engineer never left their basement, but remember, you've come to the entire life to solving a problem, which means nobody else has more credibility to make the pitch than you do, right? Because you're buying conviction. So assuming the founder has a greater sales bent, which is I actually want to be one of the co-founders, I'm the one who wants to be the go-to-market co-founder, or I'm the CEO, right? In which case, you may sometimes be better off just hiring sales reps, a director of sales, lower sort of rank and whatever, because you know what works. You want to impart that knowledge to a small set of people and off to the races. Because your marketing is generating enough leads, you can amp that up. But if you feel that you don't have what it takes to hire, train, enable, right, and make a sales team succeed, and you believe you're at the takeoff point, which is I need to hire 4 to 6 people, I've raised money, right? And you can't do an N equal to 1 experiment, right? You can't hire one SDR and say if it worked or not. You need to hire in pairs at least, right? Or pods, 2 pods, right? SDR, this solution engineer. You need to hire a couple of pods to understand what is the people who are not performing, is it the process that's not performing? In which case, a VP of sales is a good idea. There's nothing wrong in hiring a VP. I would only request, please, at 2 million ARR, don't hire a CRO. Like, don't do stupid stuff, right? Like this over-titling is such a huge problem. Very early in our life, Girish of Freshworks told us about, hey, you guys come in and I see you guys, you're like seed funded and you have like C of everything, chief this officer, chief that officer. And then when you take the lesson of not hiring C-suite at like 200K, you then say head off. Like, what is on top of head off? Nobody, right? Which means the moment I hire a senior leader at the next phase, I'm telling you you're out of a job. But that's not true. Just because a company scales and someone needs to come in, you should not be out of a job. But I've already made you head, which means I need to now, I don't know, unhead you, right? I don't want to say other words, but I need to like, what do you do with your life now, right? It makes it makes it untenable for you to be in the company. So please don't have CRO and all these titles. VP of sales, fantastic. For the longest time, Silicon Valley was built on the backs of VPs of sales. VP of product was the most important product leader. Now you have SVP, EVP, then C, whatever. Now you have a CRO. That's all much later in the game, right? So don't over title. I know you'll have to pitch keenly to get the right leader in. And that is when you start making compromises around CRO. I need this. I need to own marketing and sales. No, my marketing knows what it's doing, right? I need you to come in and scale sales, right? Neha's requirement, I'm assuming, is I know what it takes to sell to my ICP. I don't know how to predictably go to them, right? I've never scaled a sales team before. I might mishire, right? I don't know what it takes. I don't know how the process runs. If there are 6 or 8 or 10 sales reps, now that I can afford it with my funding, I don't know what it takes. So if you want someone to come in, I would say it's okay to get a VP of sales, but what are you looking for? I would ideally get someone who says, I will take the minimum pod size and structure to see early signs of success. What I will not do is take my previous Salesforce experience and say, hey, per rep productivity is 1.6 million of ACV. If I have 20 reps, I can do 1.6 into 20, 3.32 mil. Of course, there's a ramp period, and the year after we'll start chugging. What is the problem? The problem is ramp. First 3 months, zero productivity. Second 3 months, something. The last third quarter is when you start hitting quota. Q4 is when you hit quota. That means you'll close 30% of your ACV goal, right? 40% maybe. Best case scenario. What is that? That's like $500,000. So now you had 10, 20, 30 reps, closing $500,000, assuming quota attainment, if it's 100%, you're God, okay? Reality is it'll be 30 or 40%. Half of your reps won't work. So you're going to generate 2-3 million of ARR and you would have spent like 20 million that year. Game over, right? You just burnt all your investor money and also proved to your investor that you're a bad founder. So if you're getting a sales leader, they need to be of the same mold as you, which is I'm going to experiment. I'm going to see what is the minimum pod size or like 1, 2, whatever, that I can enable to do transference of the founder's understanding of PMF.
Yep.
Right?
Yep.
And see if it works, see what doesn't work, the kind of reps that don't work, the kind of process that doesn't work, the kind of marketing to sales handover that doesn't work, right? Once I've understood more things than not, there's still many things to be figured out. I will then ask you to add fuel to the fire. I'll ask you for 6, 8, 10 more reps. I'll ask for a director of sales. I'll do all of these things, right? So that person also needs to have the same thought process of experimentation, proving something at an empirical level before they scale. Very, very, very often, Neha is going to be confronted with a very flamboyant sales leader who will tell you exactly what they did at their 500 million ARR startup, right? And how they added 200 million of revenue the year prior. I know exactly how this is done, trust me, right? $20 million out, 3 million of net new ARR, you're out of a business, you're out of a job, right? So be very careful of doing those commits. So that's, I know it's a lot of thoughts, but that's approximately where I'm at as to what kind of a person you need, what level, and maybe what mistakes to avoid.
Yeah, this was great, and I'm loving. There's a common framework in all the learnings that you're sharing, which is asking the right questions before trying to come out with a solution. So I love that. My final scenario, which is actually my favorite, and it's I want to really kind of lean on your experience of having created an exit in your startup CloudCherry. So again, making up a founder name. So it's Surbhi. She has been now working very hard on a startup, 5 to 7 years into the journey, has reached reasonable scale, let's say, anywhere from 5 to 20 million ARR, just to kind of throw a number out there on scale. Now, kind of at this stage, there is now an urgency building in terms of, okay, there are now early investors, there are early employees, even the founder herself, there needs to be an exit that needs to happen at some point, right? And you need to start kind of doing some groundwork for it. Startups, as sort of both of us have seen, they're still all consuming. Things are breaking on a daily basis. There's so much of operating work going on a daily basis. Surbhi has not been, in the finance world. It's a first startup. She doesn't know anything about M&A and how to kind of really navigate that world. But now there is an urgency that, okay, I have to start doing in the groundwork, right? In terms of even creating an exit, let's say 24 months down the road. What can Surbhi start doing today very strategically in terms of making sure that, this can happen?
Well, congrats to Surbhi, 5-7 years. You've come to the best years of your life, 5 to 20 million ARR. That's already fabulous. But I like the question already because you're talking about M&A 24 months down the line, right? Because I always say, if you need something now, it's like good health, right? Fitness. I want to be fit today. It doesn't work, right? There needs to be a trail of activity and choices that you've consciously made, which aid in that endeavor. So similarly here, at SaaSBoomi, we did this at the Caravan. We do it pretty often at the annual. We're actually starting, I think it's already should be live already, an entire section on M&A, right? We're starting an M&A hotline for people who might find themselves in the midst of a process. But as part of that, we actually did an 8 vectors framework on the essence of it was biz dev that is indistinguishable from corp dev. Now, should a founder spend any time in corp dev activities as they're building? The short answer is no, right? Remember, the best acquisitions happen for companies that are destined for superstardom, going public or whatever, right? So which means if you're building to sell, maybe you're smarter than I am, more power to you, but build for the long term, build a great company, build a great product, build a great culture, build raving, fanatical customers, and the good things will happen, right? But obviously they won't just happen because if you did nothing. So the reason I said biz dev indistinguishable from corp dev is biz dev is the founder's responsibility from day one. And I don't mean biz dev in the traditional sense of the word. So the 8 vector framework that we have at SaaSBoomi, we can go into it in detail at some other session. Essentially is around, do you know your strategic ecosystem? And what do I mean by strategic ecosystem? Strategic ecosystem is anyone who has been, is, or could potentially be in your space, right? The platform players, the hyperscalers, adjacent companies. Why do I say that? Knowing the plot of your strategic ecosystem is critically important because that is the suite of products that your customers are using, right? They could be using a CRM under you. They could be using someone else integrated into you. Why do you say that? Because how do you expand TAM? You do more for the same ICP, right? You take a process, you're doing a piece of the process, you either move vertically up the process, down the process, do what, right? Or you move adjacent to the ICP or the process, right? That's how you grow TAM. Like when this is a 3-hour workshop in itself as to how to expand TAM, right? Everyone is going to be doing that either consciously or subconsciously, which means all of these people could get into your space. Now, when they get into your space, why does M&A happen? Then it goes back to a foundational understanding of M&A. I acquire a company. First of all, people acquire companies. Companies don't acquire companies, right? What I mean by that is it's not system-driven. The M&A options don't get spit out of an ERP, right? It's an exec who's thinking about the strategic future of the company or the business unit, says, this is where I need to be, right? And you're desirable for one of many reasons. Number one is if I restarted my company, my 15, 20-year-old company or this business, if I rebuilt it, this is what the future looks like, which means I'm high end of the enterprise. I'm unwieldy, I'm services heavy, hard to deploy, very expensive. You represent the mid-market modern version of it. Over a period of time, I can blend, merge, right? I can become one. That was literally our acquisition offer number one, right? Next is you're a very, very interesting feature or module to my very large platform, right? I could bundle you at $5 users a month. I have 20 million users. Literally, this is incredible. Like it's logical that you're on my platform. This success is evidenced by go-to-market partnership. You're doing very well on the app, store, exchange, whatever, right? It depends. Everyone's got a different name. And I realized, man, my foundational platform could do with this enhancement, correct? And people buy that, either a completely new module that is your company or an adjacency, which means I can solve, if I sell to the VP of sales, oh, he could also use this, right? Or she could also leverage this. So it could be an adjacency. It could be, as I said, up the value chain, down the value chain, new module or feature, V2 of your product, all of the above. The reason I asked you the first question first is when you know the strategic ecosystem, you have to understand who are you to each of these constituents. If you know these two, which is if you know the strategic ecosystem, you know who you are to them. The third question is, what are you doing to their business? Are you eating their lunch? You know how many founders say, I'm better than, I keep saying Salesforce for whatever reason, but I have a product that's better than Salesforce. Like, does Mark Benioff know? Maybe not, right? Do the channel partners know? Do the analysts know? Do the customers know? And analysts could know and talk about it even at 1 million ARR. So don't think scale is the reason why people don't, right? So one of the vectors here is third-party validation. What do people who are not you say about you? It could be G2 Crowd, it could be Capterra, it could be an analyst report. You may not be in the MQ because you don't have the scale, but the analyst would be remiss not to mention that this new company doesn't have the scale, but incredible early success. You've spoken to some customers, they say they love it, right? That's enough for you. You don't need to be on the MQ, right? Because MQ has revenue sort of cutoffs and things like that. So all of these are vectors that are relevant to your BizDev map. If you do this BizDev right and work on these vectors, engaging these people, one of the vectors we talk about is the execs love you. So if any of these companies you're strategically engaged, do you have a personal relationship with these execs? Half the time you realize halfway through the M&A, you know what the big companies thinking, especially big tech. It'd be amazing to have this team on board. It's called tech and talent, right? If you think they are, acquiring you at 100 million or 200 million for your distribution, you're dramatically wrong. They have the distribution. They're saying 200 mil for a new product category or, whatever vectors I gave you. And this incredible team, this person can come in and turbocharge our growth. So focus on BizDev, don't focus on corp dev, do all the things. In retrospect, when you do get acquired, you look back and you'll realize that the ducks lined up in a row because you did conscious BizDev activities over a sustained number of years. That is how M&A happens, right? The last, of course, is M&A happens because some exec somewhere has a hypothesis and they tell the corp dev teams, let's look at all companies in the space. It does happen that way. Then everything from third-party validation to someone knows this company, what are customers saying, all of that make a difference, right? But again, it's in the same BizDev matrix that I spoke about earlier.
But this has been an amazing conversation, Vinod. I think for me, what I'm taking away is, I think, two mental models, which is having game awareness in general, I think, as a founder. And second is really, really honing down on the ICP. I think if you can do these two things, I think these are kind of, I feel, the foundational enablers of solving a lot of these a lot of these US go-to-market challenges, which we know that a lot of founders are dealing with. And I think now we have those kind of early case studies as well of the Rocketlanes and the Spendflos of the world who are actually cracking it, right? So I think we now also have role models, and I also want to kind of close out with really a big shout out to you and the entire SaaSBoomi team. I think the kind of work that you guys are doing very tirelessly. It's a completely volunteer-led organization. It comprises of ex-founders, execs like yourself. Everyone has intense full-time jobs, but the amount of time you're giving back to the community, I think it's making a big difference. But thank you so much for joining me for this episode.
No, happy to. Thank you so much for having me, and happy to keep spreading the gospel. Like, this is what we are meant to do, I suppose.